exploring unknown tech, decoding future unicorns. Welcome to Product X, using the sharp intuition of capital and the hardcore logic of an architect to help you catch the next big event in the global tech sphere. Hello everyone, I'm Rena. Today, we are going to talk about the most secretive, yet most lucrative corner of the financial world, private secondaries. In the past, if you held original shares of a top-tier unicorn like SpaceX or Stripe, cashing out was incredibly difficult. You had to find a buyer, negotiate a price, and wait through an agonizingly long approval process from the company's board of directors. But today, San Francisco headquartered Caplight announced the completion of a $16 million new financing round. What truly made the market turn its head is the background of its investors. BlackRock, UBS, Deutsche Borse, and even capital affiliated with Fidelity. Vivian? These financial giants usually only wield power in the public secondary markets. Why would they collectively plunge back into the back-end infrastructure of the primary market? Just how massive of a problem is Caplight solving?
Wow. $13 trillion in private assets with basically zero liquidity. Yeah. That's a problem worth solving. I'm an angel investor at PreAngel Fund. And honestly, seeing BlackRock and UBS on the same cap table tells me this isn't just another fintech hype cycle.
Nolan, from a technical standpoint, the hardest part of private trading is those transfer restrictions. Many unicorn companies strictly forbid employees from selling shares privately or require the company to exercise the right of first refusal. How can Caplight's system possibly bypass these physical restrictions?
That's the million-dollar question, and honestly, the engineering answer is pretty elegant. I spent years building high-frequency trading systems, and what Caplight's doing with synthetic exposure architecture is essentially bringing that same speed and flexibility to private markets. It's not about moving actual shares. It's about building derivative contracts that track the underlying value without touching the stock certificates themselves.
Understood. So Caplight wants to put real-time price tags on unicorn equity and bypass those approval bottlenecks through financial engineering rather than physical transfers. Let's dig deeper into why BlackRock and UBS are willing to bet on this. Vivian, from your vantage point as an investor, what's the real upside they're seeing here?
Here's the thing. It's not about the platform itself becoming profitable. It's about what happens when you standardize $13 trillion worth of illiquid assets. Once you can price them, you can hedge them, you can package them into derivatives, you can use them as collateral. That's a completely new profit engine for massive asset managers, and right now, there's no other player even close to building that infrastructure. Caplight isn't just a matchmaking platform. It's building the plumbing for an entirely new asset class.
And from a technical standpoint, that plumbing is genuinely hard. You've got fragmented data from 100 different sources, fake IOIs floating around, no standard pricing model, and on top of that, you need to make the whole thing SOC 2 compliant so institutional quant teams can actually plug their models in. Most startups would have collapsed under that complexity, but Caplight's data normalization engine is actually handling it.
So the moat isn't just the relationships, it's the infrastructure itself. But here's where it gets interesting. How does Caplight actually execute trades without triggering those ROFR clauses? Nolan, you mentioned synthetic exposure, but walk us through the mechanics. How does a buyer walk away with exposure to SpaceX without ever holding a single share?
Think of it like OTC derivatives in the public markets. The buyer signs a contract that pays out based on SpaceX's valuation movement, so if SpaceX doubles, the seller owes the buyer the difference. No physical shares change hands. No board approval needed. No ROFR triggered. It's all happening in what I call the shadow layer. The platform essentially creates synthetic liquidity tools that track the underlying without touching the actual equity. That's the real innovation here, bypassing the legal complexities entirely through financial engineering.
And that's exactly why BlackRock and UBS are interested. They don't want to mess with the operational headaches of private equity transfers. They want exposure. They want to hedge. They want to trade. And that's exactly what these synthetic instruments give them. Once the contracts become standardized and exchange grade, you're looking at a Bloomberg terminal for private markets. That's the end game.
The end game is right. But let's be realistic about the challenges ahead. They've got $16 million to scale this, but now they need to handle not just top-tier targets like SpaceX and OpenAI, but also price tens of thousands of mid-tail private companies. The data dimension expansion alone is massive. And then there's collateral management. How do you handle margin calls and counterparty risk when the underlying is a private company with no public price? That's where a lot of these experiments have historically fallen apart.
Which suggests that Caplight's next funding round will likely focus heavily on expanding both their data infrastructure and their risk management systems. But before we get too far into speculation, let's do a quick lightning round. I'll throw out some quick questions. You two answer fast. First up, biggest surprise in this deal. The investor lineup, the $16 million price tag, or something else?
The investor lineup. BlackRock and UBS rarely co-invest on anything, especially not at this stage.
Same, seeing those two names next to each other on a $16 million round is honestly unprecedented.
Vivian, what's one word that describes the private equity market right now?
Stagnant.
Fragmented.
Nolan, synthetic exposure game changer or overhyped?
Game changer, but only if they can nail the collateral infrastructure. That's the make or break piece.
Vivian, predict one thing that will happen in this space in the next 12 months.
At least 2 major exchanges will launch similar private market products, and Caplight will either get acquired or become the de facto standard.
Last one, if you could instantly solve one problem in private markets, what would it be?
Price discovery. Eliminate the 20% spread between broker quotes.
Standardization. Make every private company trade like a public one.
Perfect. Let's wrap up. Vivian, give us a one-sentence summary of today's conversation.
Caplight is building the Bloomberg terminal for private equity, and the financial giants know that standardizing a $13 trillion illiquid market is the biggest opportunity they've seen in years.
Nolan, your one sentence.
They're solving a genuinely hard engineering problem: synthetic exposure, real-time data pipelines, institutional-grade APIs. And if they pull it off, they'll own the infrastructure layer for private market trading.
Absolutely. Thanks to Vivian for breaking down the capital incentives behind this deal, and to Nolan for showing us exactly how the synthetic architecture bypasses those old-school approval processes. If you want to stay ahead of the next wave of fintech and deep tech trends, make sure to like and subscribe to Product X. We'll see you in the next episode.